In 1939, World War II broke out in full force. Can you guess what happened to the US stock market at the time? A crash. Wrong. The Dow Jones Industrial Average surged by 50% in the years that followed. In March 2020, the world ground to a complete halt due to the pandemic, and everyone thought the economy was doomed. If you had liquidated your entire portfolio that day, you would have missed out on the massive bull market that tripled in value right after. It's now 2026, and the specter of war looms once again. Oil prices are soaring, and the market is in shambles. Are you thinking of liquidating your portfolio again? Just to play it safe. If you've even glanced at the news recently, you've surely felt that peculiar kind of financial anxiety, extreme panic, yet unable to pinpoint exactly what you're panicking about. Let's first take a look at the mess we're in. In late February, the US and Israel launched strikes against Iran. By early March, the Strait of Hormuz, which accounts for 20% of the world's daily oil supply, had effectively been blocked. Before the war broke out, crude oil was trading at $72 per barrel. By the end of March, Brent crude had surged to $118, a 63% spike in just 1 month, the largest monthly gain since 1988. Faced with this massive uncertainty, Wall Street reacted like a cat whose tail had been stepped on. It completely collapsed. The S&P 500 posted its worst quarterly performance in years, while the Nasdaq plummeted more than 10% from its peak. Microsoft has fallen more than 20% this year, and Tesla has dropped over 21%. Wall Street's fear gauge, the VIX, has more than doubled, surging from the teens to over 35. CNN's fear and greed index now hovers pitifully between 8 and 17. Such extreme fear levels have occurred with only a 3.4% probability across all trading days over the past 15 years. Every financial media outlet is frantically urging you, buy gold now, cash out your stocks immediately, the sky is falling. But do you think your real enemy is the gunfire in the Middle East or the S&P 500's plunge? You could be more wrong. The trap that will prevent you from recovering over the next decade and even cause you to underperform inflation is the deeply ingrained financial common sense in your mind. Let's cut straight to the heart of the first and most deadly financial myth. Many people believe that cashing out investments and holding cash during a crisis is a responsible hedging strategy. It sounds perfectly logical, right? It's pouring rain outside, so we stay indoors. But the problem is, the weather rules of the financial world don't work that way at all. Imagine a typical American family that commutes 40 minutes by car every day. The war hasn't even started yet, and gas prices at the pump have already jumped 35%. Next, a trip to Costco reveals that your bill for eggs and milk has skyrocketed as well. Every news story about crude oil breaking the $100 mark eventually translates directly into extra numbers on your bill. This is precisely the chain of fear that bears love to peddle. Soaring oil prices drive up transportation and manufacturing costs, which in turn fuel widespread inflation. Once inflation rises, the Federal Reserve can't cut interest rates as planned. If things get even worse, they might even have to raise rates. Higher rates slow economic growth, and when combined with high inflation boom, that's every financial expert's ultimate nightmare, stagflation. They pull out the script from the 1970s to scare you, telling you we in for a decade of economic stagnation. I'm not saying this worst case scenario is impossible, but comparing 2026 to 1973 is as absurd as diagnosing someone with brain cancer just because they have a headache. Yes, they share a common symptom, but the underlying physiological mechanisms have completely changed. In 1974, inflation was as high as 10.1% and was racing toward 14.5%. Unemployment had reached 9%, and the U.S. economy was actually shrinking. Most critically, the U.S. at that time was almost entirely dependent on foreign oil imports, and workers' wages were rigidly tied to the cost of living. This created a vicious cycle. Prices rose, wages were forced up, business costs increased, and prices continued to rise. This vicious cycle forced Federal Reserve Chairman Paul Volcker to raise interest rates to nearly 20% just to barely bring inflation under control. But let's look at today's data. Inflation currently stands at around 2.7%, and the unemployment rate is stable at 4.2%. GDP continues to grow. More importantly, the United States is now one of the world's largest oil producers, and productivity, which had collapsed entirely in the 1970s, is now growing robustly at a rate exceeding 4% annually, thanks to the widespread application of artificial intelligence. The structural conditions that turned the 1970s into a decade of disaster simply do not exist today. Top economists who have actually run scenario simulations put the probability of stagflation at 20 to 40%. It is merely a risk, not the baseline. And most crucially, the market is very smart. It has already factored the worst-case scenario into today's plummeting prices. In other words, if the worst-case scenario does not fully materialize, and history shows it usually doesn't, then prices can only move in one direction from here. But do you really think that just because you understand macroeconomics, you can make money in the stock market? The real trap that makes you hand your money over to Wall Street is actually hidden in the intuition you feel every time you open your brokerage app. Let's debunk the second myth. Ordinary people always think, I'll wait until market sentiment stabilizes and the news stops reporting on the crisis before I re-enter the market. When you get a certain gut feeling about the stock market, take my advice. Go to the bathroom and flush all your stock market instincts down the toilet, because that's the only place they belong. We only trust data. RBC Wealth Management once conducted a truly eye-opening study. They analyzed 20 major military conflicts that have erupted globally since 1950. These included the Korean War, the Vietnam War, the Gulf War, the Iraq War, and the Russia-Ukraine conflict. Guess how much the S&P 500 fell on average during these wars? Just 6%. Even more astonishing is that the market bottoms out after an average of just 13 days and fully recovers its losses within an average of 28 trading days. Take a moment to really let these numbers sink in. From the crash to a full recovery, the entire process took less than 6 weeks. While you were at home trembling, glued to the news, waiting for the so-called uncertainty to clear, feeling sick to your stomach at the shrinking numbers in your account, the market had actually quietly staged a stunning turnaround. Those who gritted their teeth and stayed in the game reaped the massive rewards of this surge. Meanwhile, those who thought they were being clever by cashing out didn't make a single penny. When Iraq invaded Kuwait in 1990, oil prices skyrocketed and the stock market plummeted. Doesn't that sound exactly like today? At the time, the S&P 500 fell nearly 16%. But guess what happened in the year following the war's end? It surged 29%. On the day the Iraq War began in 2003, the Dow Jones Industrial Average didn't fall. It actually rose by 2.3%. Over the following 12 months, the S&P 500 soared by 26.7%. I know this sounds crazy. Wars feel like the end of the world, both emotionally and economically, but historical data coldly tells us that for capital markets, they've never been the end. The US economic machine is simply too massive enough to absorb any shock that doesn't directly bring it to a halt. What's happening now doesn't even come close to bringing it to a standstill. The historical record of the past century makes it crystal clear. On average, each bull market lasts nearly 5 years, with returns as high as 1977%. Meanwhile, the average bear market lasts a mere year and a half, with declines of around 35%. If you extend the time frame to a 10-year cycle, your probability of making money is 94.1%. If you extend it to a 20-year cycle, your probability of making money is 100%. You heard that right, 100% in recorded history. Whether it was World War I, the Great Depression, the oil embargo, or the financial crisis, there has never been a single exception. Now that you understand the logic behind these market sell-offs, aren't you itching to take all your savings and go bottom fishing? Stop. If you don't grasp the underlying screening logic of Wall Street, every penny you invest could end up buying a pile of financial junk. How do the true masters operate? We must translate these obscure financial theories into the kind of American street wisdom we can all understand on a daily basis. Actually, investing in a panicked stock market is just like shopping at Target or Costco on Black Friday. Imagine walking into a Target and seeing the latest Apple MacBook Pro or the newest Sony television with a big yellow tag that says 30% off everything. What would you do? Would you scream and run out of the store thinking the place is going out of business? Of course not. You'd immediately pull out your credit card and buy it, because you know the item's intrinsic value hasn't changed. It's just temporarily marked down for some reason. But in the stock market, when the world's greatest companies, those that make money like money printing machines, are tagged with 30% or 20% off, the vast majority of people react by panicking and running out the door. Why? Because fear is setting the price, not fundamentals. Go back to March 2009, when the stock market had plummeted by 57%. News outlets across the US were on a loop, broadcasting terrifying images of General Motors filing for bankruptcy and banks collapsing. All the experts were warning that this could be a structural economic collapse with no end in sight. But imagine an ordinary person, not a Wall Street hedge fund manager, nor a lottery winner, just an average working person with nerves of steel. Starting in March 2009, he invested $500 in Amazon stock every single month, rain or shine. Over the course of a decade, he invested a total of $60,000. Guess how much that $60,000 had grown to by the end of 2019? About $2.3 million. This isn't a story about a once-in-a-lifetime genius. It's a story about someone who kept moving forward, even when everyone around him was screaming, "Run!" Nor is it about winning the lottery. These people were buying shares in the most powerful, monopolistic companies on the planet. These companies were beaten down to rock-bottom prices during the panic. And today, look at what's sitting in the bargain bin. Microsoft is down over 20% this year. Amazon is down nearly 9%. And Meta is down over 8%. These companies, with their generational dominance and massive competitive moats, don't rely on who wins in the Middle East for their annual profits. But right now, simply because of geopolitical panic, you can buy them at prices you wouldn't have dared to imagine 6 months ago. At this point, you've already gained the insight needed to outperform 90% of the average investor. But I must warn you very seriously, even if you currently believe every word I've said is absolutely correct, even if you know these figures by heart, next Monday morning, when your brokerage app pops up a red alert signaling a market crash, you'll still feel an overwhelming urge to sell all your stocks in exchange for so-called security. Why? This is the deepest underlying reason why you lose money. This leads us to the third myth we must debunk, that investing is determined by your IQ. No, investing is determined by your animal instincts. Daniel Kahneman, the titan of behavioral finance, spent decades of research proving a devastating conclusion. The pain of losing $1 is roughly twice as intense as the joy of gaining $1. This isn't a flaw in your character. It's the default setting hardwired into your genes by millions of years of evolution. In the days of primitive tribes, the ancestors who reacted most strongly to loss and danger survived, while the optimistic ones were devoured by lions. Now, this nervous system designed to evade lions sits inside your skull, staring at the red, plummeting numbers on the screen and frantically sounding the alarm, "Run for your life." This is why, after tracking investor data for 30 years, Dalbar uncovered a brutal truth. Over the 30 years ending in 2015, the S&P 500's average annualized return was 10.35%, while the average retail investor's actual annualized return was a paltry 3.66%. That's a difference of nearly 7 percentage points every single year. What does this mean? Over 30 years of compound interest, it's the difference between retiring comfortably in Hawaii and having to work as a cashier at Walmart at age 70. Why is the gap so huge? Because ordinary people always sell off their holdings in environments of extreme panic, like the one we're in right now. JP Morgan's data is even more chilling. If you invested $10,000 in 2000 and left it untouched, you'd have over $64,800 20 years later. However, over those roughly 5,000 trading days, if you missed just the 10 days with the highest gains, even if it was only 10 days out of sheer panic, your money would be cut in half to just $29,000. If you missed 30 days, you wouldn't even keep pace with inflation. And here's the most shocking secret. 76% of the stock market's best performing days occur during bear markets or in the first 2 months of a new bull market. The very days that build your lifetime wealth are hidden right within the environment of extreme fear we're re-experiencing right now. If you exit the market out of fear, you'll never reap these rewards, and you can't turn back time to make up for it. Alright, if you haven't scrolled past this yet, congratulations, you've already outperformed the vast majority of average investors. Next, I'm going to give you an extremely specific, high-probability action plan that you can put into practice the very moment you wake up tomorrow morning. I don't need to predict whether the market will rise or fall over the next 6 months. Anyone who claims to be able to predict short-term trends is definitely trying to sell you an expensive paid community. My system will automatically accumulate wealth for you, regardless of whether the market is ranging, falling, or rising. Step 1. Build an unshakable core portfolio. Allocate 40 to 50% of your investable capital to a broad market or S&P 500 ETF, such as SPY or VOO. This is an unbeatable powerhouse with a perfect track record over the past century. No human fund manager has consistently outperformed it over a 20-year horizon. Right now, they retrading nearly 9% below their all-time highs. You rebuying an asset with a flawless long-term track record at a panic discount. Open your brokerage app immediately. Set up monthly automatic purchases, and then move that app off your phone's home screen out of sight, out of mind. Step 2. Layer super monopoly companies on top of your core portfolio. Look for high-quality companies with extremely robust business models, such as Microsoft, Amazon, Meta, and Google. Their ability to generate cash is fundamentally unaffected by the long-term impact of the Middle East situation. Buy those core assets that have been unfairly punished by panic, rather than junk stocks that are already losing money. Step 3. And the ultimate secret that determines whether the first 2 steps succeed: counter-intuitive contrarian scaling up. During terrible market months, stick to your dollar-cost averaging discipline. If your cash flow allows, buy more, not less during the worst months. There is a cruel beauty to the math here. When your monthly investment amount is fixed, if the market crashes by 30%, your money can actually buy 43% more shares than before. If the market crashes by 40%, you can buy 67% more shares. During these red months, you aren't losing money. You're taking advantage of the massive sell-off to aggressively accumulate ownership in great companies. A research firm analyzed the period from 2007 to 2014, a cycle that spanned the financial crisis, and found that those who stuck to mindless monthly dollar-cost averaging achieved a 66% return. Meanwhile, those who dared to double their investment amount whenever the market dropped more than 5% earned nearly 84%. And what about those who panicked and sold? They ended up with nothing, not even the paltry interest from their checking accounts, which isn't even enough to fill a tooth cavity. Once you understand this mathematical logic, you'll have to face the reality of your current situation. You now have only 3 paths before you. The first path is to liquidate your position and run. Sell all your stocks, convert them to cash, and wait until the world looks safe before coming back. This may sound prudent, but it is actually the ultimate financial suicide, because that safe signal always arrives belatedly, only after the market has already surged significantly. You'll pay an exorbitant price for this so-called sense of security. The second path, play dead and stay put, neither sell nor buy. This is better than the first option. At least you've preserved your principal. But you'll also miss out on a historic compounding opportunity to accumulate cheap shares at panic-driven discounts. Inaction is synonymous with mediocrity. The third path, keep investing and even increase your position against the trend. Set aside your emergency fund for the next 12 months, then invest the money you had already planned to invest without hesitation. This is a discount you couldn't have gotten 6 months ago. What if the market keeps falling? All the better. Your monthly dollar cost averaging will continuously lower your average cost. When the economic recovery time tested by the past century finally arrives, your wealth will explode like a spring compressed to its limit. Let return to those two young men from 2009 at the beginning of the video. Same income, same $5,000 in principal. The first man, overcome by fear, chose to retreat and cash out. Was he wrong? From a human instinct perspective, he wasn't wrong. He's only human. At the time, every newspaper was supporting his decision to protect himself. But the reason the second person was able to grow his account to $210,000 is that he deeply understood a truth that goes against human nature. Those signals that make you feel absolutely safe will always sound only after the wealth train has already left the station. By the time you feel everything is safe enough to buy freely, the best prices have long since vanished. What truly separates people across wealth tiers isn't your IQ, your starting salary, or even insider information from Wall Street. It's whether you can interpret cold, hard data, and when all your friends are spreading anxiety and all the news is peddling panic, use reason to overcome your nervous system and force yourself to hit that buy button. This gap between knowing and doing is the chasm that separates ordinary people from multimillionaires. Now, the window for this generational wealth transfer has opened once again. Most people will feel a physical discomfort at the sight of red numbers and make a fear-driven decision. 10 years from now, they'll sit in a bar watching former colleagues drive Porsches and ask in bewilderment, how on earth did they get rich? You absolutely don't have to be the one regretting it 10 years from now. All you need to do is understand this mathematical principle. Turn your money into a slave that works for you 24/7. Reclaim control of your life and achieve true freedom of choice. This window of opportunity is wide open for you. Whether you step through, it is entirely up to you. If you feel this video has changed your perspective on the market for the coming months, please leave a comment below. I read every single one. If you haven't subscribed yet, click the subscribe button now. See you next time.